Singapore's general insurance sector grew in 2024, but rising claims cut domestic underwriting profit by 16.7% despite strong premium growth. Here to expound on this is Sumit Narayanan from EY. So, Sumit, how concerning is this drop in domestic underwriting profit?
Actually, if you look at it, the 16.7% drop in underwriting profits may appear to be concerning at first glance, but it's important to kind of put this in context. This drop is primarily due to two reasons. The first being inflationary pressures on the motor insurance business, and the second was a one-off large loss in the marine hull sector. Now, both of these do not have a long-term impact on the profitability of general insurance in Singapore. As such, we believe there is less concerns over the health of the general insurance sector. Now, that being said, I think these developments do provide a good opportunity for the need for insurers to closely monitor their portfolios and at the same time further enhance the risk management framework to kind of grow profitably.
On that note, are rising property, travel, and health claims eroding profitability?
Now, it's important to understand that there is rising inflation, there is changing consumer behaviors, and increasing medical costs, which are actually putting pressure on the profitability of insurers across a whole host of lines of businesses such as property, motor, travel, health. However, we've seen in Singapore that the general insurance premiums in the domestic business have grown at a fairly healthy rate, and the insurance companies have been actively monitoring and managing their loss ratios. As such, again, whilst there should be some concerns around how insurers look at profitability in the future, we believe these elevated claims present opportunities for insurers to further sharpen their claims management practices, improve operational efficiencies through investment in technology, and at the same time focus on customer segmentation so that they can continually grow their business profitably.
Just a follow-up on that, Sumit. How vulnerable would you say is the sector to climate-related losses?
Actually, the insurance sector is susceptible to climate-related risks, and this is not just on the impact natural catastrophe claims have on the loss ratios, but also there is the impact of business interruptions and deteriorating credit rating on due to the counterparty's climate policy. While regulatory requirements in this space have been evolving, I think we've been working with a number of our clients in general insurance in helping them set net zero targets, decarbonizing their underwriting and investment strategies, and also incorporating climate related risks scenarios in stress testing. These actions aim to strengthen the sector's resilience to the impact of climate change.
And aside from that, anything else we should prepare for? What risks could further pressure margins in the coming year?
I think obviously there's the ongoing uncertainty around what global trade tariffs would do. Market experts believe this could heighten inflationary pressures across multiple insurance sectors. Now, even if tensions ease, market experts would say a full return to pre-disruption conditions is unlikely in the short term. This does mean that whilst the full extent of the inflationary cost remains uncertain, there could be pressure on insurers' profitability in the short to medium term. The impact of this on the underwriting margins would depend on how much the insurers are able to pass on these additional costs to the policyholders, and at the same time, how insurers invest in technology with a view to improving operational efficiency, better target customers around acquisition and serving customers. So there is risk from the ongoing global trade tariffs on the insurance sector.
Thank you so much for joining us today, Sumit.
Thank you.
Once again, that was Sumit Narayanan, EY ASEAN Financial Services Managing Partner. For more news, visit insuranceasia.com.